Today we are going to discuss and we are going to start a new topic, that is what is a market, what are the types of market, and what are the structures of market. Why this is important to study, guys? Because for making any decisions for investments, we need to understand what type of market that country is having, what type of companies are performing in that country, and it's a macroeconomic topic basically. It will enhance your understanding, how to invest, where to invest, and what types of companies are, and how these companies are working, how the industries are working, what types of markets are there. So this is really going to help you, to broaden your perspective in economics. So what we are going to discuss today: what is a market, what are the types of market, and what are the different structures of market and their characteristics. Now, let me ask you a thing. What do you mean by market? So there's a picture as well. So people are buying or selling something. There are people who are selling, there are people who are buying. So it means a transaction is taking place. So market is a place where transactions takes place basically. Now it could be transactions of anything. It could be goods, means physical goods. It could be commodities. It could be services as well. It could be some virtual, securities, piece of paper like this. Securities can also be traded in markets. So markets are place where transactions takes place, any economic activity takes place, and transaction of what? There is exchange of something takes place. Exchange could be of services, could be of financial assets as well, means tangible as well as non-tangible things. Tangible means commodities which we can touch, and non-tangible means like piece of paper, means we are exchanging it. So these are financial securities. I hope this is clear to everyone. So there will be two parties over here. One would be buyer, another would be seller. Now, as I told you, transaction takes place between two people. One is a buyer, another is a seller. So what exactly happen in a market? There will be a person who will be having some kind of commodities, goods, services, or some financial securities to offer. He is trying to sell it. And there would be a person who would be having some money, and he would like to buy something like a good service, a good something like commodities. He would love to buy financial securities. So there is a transaction taking place by two people. One is giving something, another is paying money for that. So this is how markets work. The transaction takes place between two people. And the same thing will be applicable throughout, whether it is stock market, whether it is financial securities, always there will be two parties involved. It's very important to understand. Same happens in monetary policy as well. Government issues government securities, people invest in that. So government is the one who is selling, people, we citizens of India, we are the one we are buying. So two people, again, buyer and seller. So it will be applicable in all the markets, whether it is financial market, goods market, commodity market. So this rule will be applicable throughout. Now, a question would come, all right, sir, there is a buyer, there is a seller, but how the prices will be decided? Now, again, this concept will be applicable throughout, guys. Now, if there is a buyer, there is a seller, they may charge as much as they wish to charge for anything, means like for good service, for services, for goods, for commodities. So a seller can charge anything, but who will decide the price? So the prices are decided basically it's a natural phenomena, that is demand and supply. And this phenomena you can see throughout the world, throughout the nature as well, throughout the universe as well. So demand and supply is the thing which decides automatically what buyer will be paying to the seller. Now the thing is that a question that should be coming in your mind, that what if the sellers are adamant and they are selling in very adamant prices? Now, for that, there would be a regulator that would be coming in. Now, the thing is that, guys, if such huge transactions are taking place, see, there's such a crowded place, right? So even in a class, there must be, in a school days, in a college days, there must be a monitor. Then there must be you know a class representative or a monitor, or then a class teacher, then a college principal. Means when there is so much chaos anywhere, so there are people who are trying to regulate this chaos, to control the chaos so that it doesn't go out of hand. Then comes the regulators, guys. These regulators, they manage these markets. They manage buyers and sellers, interests of buyers and sellers, means they keep the interests of buyer as well as interests of seller in mind, so that both the parties gets the best that they could have got in the market, and they also try to manage and regulate the prices of the market. So that is why regulatory bodies come into play. Goods and services, I told you, there is exchange of something that takes place. It could be goods, it could be services, it could be financial assets as well. Financial assets means, guys, these are non-tangible assets, just piece of paper, your bonds, shares. You only get piece of paper, and these piece of paper you can exchange with money basically. So this is how these are some participants who takes place and who controls, who try to manage these markets basically. This is how it works. Now, what are the types of market, and what are types of market structures? Now this is important, and this is important to understand, guys. As I told you, the price part plays a very important role, right? The seller can sell the products to buyer at any point and any price, right? But guys, there are few concepts that come into play. Means this price regulation as such, it takes place because of demand and supply, but there are few structures of market where this concept bit changes, because these players, these companies, they tend to regulate, manipulate the supply and demand. And this is how they tend to control the prices. Now I'm sorry, we are going to learn this thing only. So, types of market structures include perfect competition, monopolistic competition, oligopoly, and monopoly. Now, we'll start from monopoly first because you might have heard monopoly multiple times before itself. So, guys, monopoly means there's only one seller of any single product or any services. There is no competition at all, right? So, there is just one seller, and the product is so unique that other people can't even can't even produce or manufacture that product, or can't even give services similar that person is giving. So no entry. The entry is so difficult. For example, the best example that I could give for this thing, the best practical example could be, for example, Mr. Ashok, his mother can make such a delicious biryani that no one in the market can make it. So she will be having kind of monopoly over here. Means uh, this is not a let me change the example. This example is relevant in some another place. Let me change the example. Let's take the example of iPhone. When iPhone started, there was no company having touch in the phones when they started for the very first time. That was a monopoly basically. So whenever a company is making a product which is very, very difficult to replicate, means for example, it could be patented drugs, it could be utility companies, it could be, new technology that is emerging. So the entry barrier is very, very difficult. Now, if I ask you a question again over here is that, can you manufacture iPhone at your home? So the answer would be absolutely no, because manufacturing of iPhone will require immense amount of competence in technology. Means the way the screens are designed, the chips are designed, the battery are designed. It requires a huge amount of an immense amount of technology, knowledge and expertise. So we can't do it basically. So if I say these, that is why there is a barrier of entry, right? Because you can't make it. You all my students, all my, even in my class, we were engineering background students. We were unable to manufacture iPhone at our homes because the barrier is so high. So no one can enter here. So there's high entry barrier. So, and there is only one single player in the market, means one seller in the market. So that person can decide any price for selling, any price, because there is no substitute. So over here, as I told you in the previous slide, that prices are dependent upon demand and supply. But this because of this monopoly, the demand can be controlled and the supply can be controlled. Because the supply is controlled and restricted, the demand can be increased, and because of that, they can charge immense amount of prices and high amount of prices from the customers basically. So monopoly, if I summarize, in monopoly, there is only one single seller. The product is so unique that it's very difficult for other competitors to get into this. And they have huge amount of market power. Huge amount of market power means they enjoy uh, you know uh, they can control the prices of the commodity basically. So they enjoy that thing. So that is why uh, monopolies are the best examples of monopolies are only the scientific or the research oriented companies where the R&D is very high. So these companies can create huge monopolies. Means, for example, drugs companies. For example, the best example, the related example would be during the COVID crisis, only one or two companies were making the vaccines for this. So the thing was that that was monopoly. There was no another option, right? So in monopoly, the price there is a power in the hands of company that they can control the prices, and the consumers they don't have any option for this. I hope this is clear to everybody. Now moving to oligopoly. Now oligopoly, what happens over here in monopoly as a term, English terms itself suggests you mono means one, oligo means when there are three or four companies, in the same sector. So these are five, three or four companies. These could be large companies, and these companies are, the best example, the relatable example today would be Swiggy, Zomato, and Uber delivery partner. That there is some Uber Foods, if I'm not wrong. So three companies in just one sector. So the thing is that no other people, other companies can enter into this because it's very difficult because they are having huge market shares and they're competing with each other basically. Another example would be automobile industry and airline industry. There are only three or four or five companies, airline companies, which exists basically. And these companies, the competition is very high because if one company decides one thing, another company has to follow that. Means the decision making is dependent what other company is doing basically. Let me give you an example. If today Swiggy decides to give 50% discount to its customers, there will be no option for Zomato that they can't give that they should not give the discount because they have to give the discount because the decision making of a company will be completely dependent what another company is doing. If Swiggy is giving 50%, even Zomato have to give. If not 50, then 51, 52, so that they can compete with the company. So the thing is that over here, the sellers are few over here. The number of the businesses creating, just like the sellers are few. So again, it's just like entry barrier is difficult. So new entrants face significant challenges because these three or four companies are that dominating in this field. And if a new person is entering, he really need to have a lot of funding so that he can compete with these three or four companies, right? There is interdependence, as I told you. Interdependence means action of one business will really impact the action of another business or the decision making of another business. How it works? If you might, if you remember, guys, when Uber was launched in India, at the same time Ola was also working, right? So Uber was giving first five rides free, so Ola also had to give it. Uber was giving heavy discounts to the customers. Same Ola had to give it, had to do it. But Uber was having international funding, and Uber was very high. The fundings in Uber was very high, so it became very difficult for Ola to compete with it. But the decision making of Ola was completely dependent what Uber was doing because the decision making of one company will be completely dependent upon other company what another company is doing. I hope this is clear to everyone. The entry barrier again is very difficult over here. Means automobile company, airline industry. It is very difficult to enter into such kind of businesses, guys. Why? We can't start a airline industry just like that. It's not an easy business to start. You need to have a lot of funding. You need to have a lot of knowledge in airline sector because it is very uh, the prices are really very cutthroat competition is there amongst the airline industries, and it is completely dependent upon the crude oil as well. So if the crude oil prices goes up, the profit margins of the airline industry also goes down. So the thing is that oligopoly is good, but oligopoly means there is dominance of three or four players in the market who are ruling the entire market. And it's very difficult for a new entrant to enter into net business. It will be very difficult. Now, before we proceed into this monopolistic competition, let's do a simple thing first. Perfect competition. Guys, as you know, in the real world, nothing is perfect, right? There, there are, when the reality comes, there is there are shades of gray basically. Generally, if I tell you what perfect competition is that now there are large number of buyers and sellers. The product is homogeneous, free entry and free exit, and the best example is agriculture market. Now, let me tell you how it works. There are so many farmers. So many farmers are growing wheat, for example. The quality of wheat will be more or less quite similar to each other. There will be very, very less difference in the quality of wheat. Everyone is producing the same thing. The thing is that over here, the product is homogeneous. There is no differentiation in the product. Now, what would happen? If farmer A is producing wheat, farmer B is producing wheat, C is also producing the same kind of wheat, the supply is so high that they can't demand and they can't, demand high prices from the customers. Because if customer is not getting optimum price from Mr. A, he will go to Mr. B or he will go to Mr. C. The product is same. Now the thing is that guys, in such kind of markets, anyone can enter and anyone can exit any point of time. Now, the best example again, it could be over here is that if you want to start a restaurant, anyone can start a restaurant because it's very, very difficult to bring differentiation in the product because all the products, in many cases, products are quite homogeneous, right? It's just you can what you the best you can do is to change the ambience of the restaurant, change the location of the restaurant, but more or less the quality of food and the taste of food is the only thing that will differentiate it. And if the quality and the taste of produce of the food or the items you are preparing is not differentiated, it will be homogeneous and you can't price higher for that. You can ask higher prices for that. What I wanted to say for this thing is that whenever we are starting a new business, guys, we should try to make our products more differentiated, more heterogeneous, so that no one can replicate it. Faster it can be replicated, more competition there will be. I hope you are getting the point. What I wanted to say over here is that in perfect competition, there are so many players. The number of people are so many in the business, right? The product is same. Everyone is selling the same product. Now the thing is that if one person is decreasing the price, another person also have to decrease it because otherwise no one will buy because the product is already homogeneous and the entry and exit is very, very, easy in these businesses. Means anyone can start these businesses. It's that simple. Now, if I ask you a question, guys, which is easy to start a company like Apple, technology-oriented company, or to start a agricultural venture, or to start a small restaurant or a small dhaba? To start a small dhaba is much, much easy. I'm not saying it is really easy, but it also has so many challenges. But as compared to technology intensive business, it is very easy. Anyone can start, anyone can enter any point of time, and anyone can exit any point of time. Whereas starting a technology intensive business is very difficult. You need to have good understanding, good supply chain, good logistic, everything should be sorted out. So that is why, guys, perfect competition is good in terms of consumers because consumer will get the products at cheaper prices because competition is so high, right? There are so many sellers basically. But the perfect competition, it is not that good for the businessmen, for the companies, for industries, because if the product is easily replicated, it will become very difficult for the companies to sustain for a long period of time, to maintain good profits in the long run. So that is why it is always advisable to have a product which is differentiated, which is different from the market, differentiated, heterogeneous, or which is very difficult to replicate. Because just try to think, guys, if someone can replicate a product, so many people can replicate the same thing. So if you start a business today, after 2 years, there will be 100 similar businesses like you. and your identity will be lost. So that is why it is important to start a business where the product is or product, it could be either product or service or anything which is differentiated. I hope this is clear to everyone. Now, guys, let's see this term, monopolistic competition. Now, over here, two terms are joined together. One is monopolistic, another is competition. Means it will be having characteristics, traits of monopoly as well as competition. It's a good thing as such. Means combination of both, characteristics of both. Now, many sellers. Now, over here in monopoly, there was one seller. In competition, there was multiple sellers. So let's see how it is, having the characteristics of both. There are many sellers, but they are selling differentiated products. Means products are different with everybody. Means let's give you an example. I was giving you an example of in the previous thing that if you start a restaurant, if you start a dhaba, and if your food is not differentiated, it will be so difficult because the competition will be so high. But just imagine in the same restaurant, if you start giving some Chinese things, some Korean products, some products from Gulf countries, it will be differentiated. Now, that thing no one is giving in the location, right? Now, what is happening over here? In this, the number of sellers are many, but the products are differentiated, just like Monopoly. So, what I wanted to say over here is that in Monopoly, the product was differentiated, right? There was no one like that. Similarly, what you are doing over here, their number of the best example, let me give you one more example over here would be, let's take the example of cold drinks. Everyone is selling cold drinks. There are four or five good companies who are selling cold drinks, but their products are differentiated, guys. The flavor of Coca-Cola would be different from Dew. The flavor of Dew would be different from Mazda. So these are sugar drinks, right? These are cold drinks. But the thing is that they have differentiated the products. Competition is there. I do agree with that. But the thing is that because a product was differentiated, people will sometime, will have a picture and a taste of a product that is different from others. So they will desire for a product. The same goes with the restaurants as well. You can serve simple dal roti, simple dosa, which everyone is selling, or you can differentiate the product, which other people are not doing. This way of, starting a business is a good way of starting a business to earn money at least. Because if your product can be replicated, it will be difficult, guys. So there, in this thing, what is happening? In this thing, both the parties have win-win situation. Sellers also have win-win situation because you are selling some differentiated product and you can sell that product at a price which you like. Means you can charge some higher price because of that differentiation. What consumer is getting a good product, and consumer is having some form of competition as well, because you over here you can't charge very high prices because still there is a competition, still there is a chance of replication of the product. So there is some control, but at least consumers are getting good products. Consumers don't have to pay very high costs. On contrary, in monopoly, only in monopoly, the company can charge as much as amount they want. The best case is iPhones, best case is MacBooks. In MacBooks, iPhones, the technology is so high-end technology that the manufacturing cost of an iPhone is just 20-30,000 and they're charging 1.5 lakhs for that. So that margin is so high. Why that is so high? Because no another party can do it. Now the prices of iPhones have started coming down because Chinese companies have started replicating it. Samsung have started replicating it. So that is why monopoly, there is a very good chance of earning more profits. Now, I would like to ask you a question, guys. Being a customer or being a customer, you can let me know which type of market would be better. And I know many of you would be saying perfect competition would be better, sir, because the prices of the products are too low and we can enjoy less prices. Inflation would be very less. But I want you to think, is it only perfect competition that is beneficial for an economy? Or shall I give you some another way of thinking? Just think and then I'll answer, guys. You can pause the video. Now, the answer that I would be giving, Perfect competition as such is good, but in perfect competition, the profit margins are very low, very, very low, because everyone is selling the same product. So if the profit margins are low, so would that company spend money in R&D? Anyhow, the profit margins are low. So why would company invest in R&D? So in real world, guys, perfect competition, there should be some monopolistic competition as well. Both the things are equally important. Why? Because in monopolistic competition and in monopoly, basically what happens, the profit margins are very high. And if the profit margins are very high, only then the companies will invest their money in R&Ds, because the profits are so high that they can R&D the product and they can make the better products. So being a customer, and being in the real world, there should be a combination of both perfect competition and imperfect competition. So the perfect competition is the first part, and next three can be considered as imperfect competition. So in the real world, perfect competition plus imperfect competition both are equally important, because if there is only perfect competition, there will be no upgradation in the products. The products will not become better. But if there is imperfect competition as well, the companies would be investing in R&D as well to improve their products, and the customer will be getting better products in future. So I hope this is clear to everybody. Now, so this is very important, guys. We need to understand these things. The most confusion that comes in monopoly and monopolistic competition. We will be doing the comparison part over here. Now, let's see perfect competition. Perfect competition is when there are so many companies selling same product. So when all of us are selling same product, it will be very difficult to charge high price from the consumer. This is perfect competition. Monopoly, one company selling one type of product, and they can charge any amount of prices from the customer. It is good for a businessman basically. And why they are having why there is only one company, or why they are selling only one type of product or differentiated product, because it is high technology oriented companies, right? So it requires scientific research, it requires science basically. The best example of monopoly, a few years back or nowadays itself is, Starlink, satellite internet connection. So no one is doing this thing. So Elon Musk can charge as much amount of money he can, right? Now, oligopoly, three or four companies in the same domain, but they are trying to compete with one another. But there are only three or four companies. So decision making of one company is affected by decision making of another company, right? A monopolistic competition is just like perfect competition, guys. There are so many companies, but in perfect competition, the product was similar, same product. In monopolistic competition, every company, there are many companies, and every company is selling a different product. If not different, then differentiated. Heterogeneous means if Mazda is selling Mazda, then another company would be selling Dio. Next company would be selling Coca-Cola. So what is happening over there? The flavors are different. So cold drinks, it is a market of cold drink, but the flavors are different. So this is how these all, and being an investor, what you should be looking. Being an investor, what I should be looking at, this is the best thing for me. Or monopolistic competition is also good for me. Why I'm saying this thing, guys? Because being an investor, I would like to invest in a company where the profit margins are high. Only then my investments will grow, right? So we should invest in those companies where the entry barriers is difficult. The products are very difficult to replicate. No one can enter any point of time. That if I could find such kind of companies, it's the best companies for the investments. I hope this is clear to everybody. Now, guys, further classification of the markets would be, you know, what types of financial markets are there? Means, see, there are markets for goods, there are markets for finance itself. Now, if I say, what is a financial market? So how it works basically, guys, in the previous markets, we were giving services or goods. But over here, again, It's a market, first of all, right? So two people will be involved, one buyer, another seller. Now, over here, I would be selling a piece of paper, non-tangible things, right? I will be selling this piece of paper to you and I will be taking money from you. And you can resell this piece of paper to someone else. So this is how these financial markets takes place. This is first thing. Now, financial markets also have subcategorizations: capital market, money markets, derivatives, and commodities. Now, let's see how it works, guys. Capital market is for long run. If I tell you in a very short, in a crisp way, for long run investments, example stocks and bonds. Money market for very short term. Derivative markets, these are contracts, and commodity markets, we are dealing in physical goods basically, but on contracts. Now let's see how it works, guys. Capital market, why the term capital market was given? Because I am raising capital. Now, how it works, guys? I am a businessman, you are an investor. Again, it's a market, so two people will be involved, always two people. I need money, and you had money. I need money for my expansion, for the growth of my business, but I'm not having money. You are a person who is having good amount of money, you need to invest it somewhere. So in this market, we both people meet and you gave the money to me, right? But in this thing, the markets are divided in stocks and bonds. How it works? If I take money from you with a promise, a written promise given to you, an obligation that I, Pranayas, I will take 1,000 rupee from you today, but I will return 1,200 after 1 year, and I will give this piece of paper to you. So transaction took place. You gave me 1,000 rupee, I gave you one piece of paper. This is a bond. So this is a bond market. And these bond markets are also called as debt markets. Debt means I didn't go to bank to take loan. I took loan from you. Or I can take loan from general public, means public of India, right? So issuing these piece of papers, these are bonds, right? So how transaction is taking place? You are giving me the money. I am giving you this piece of paper. It's a promissory note. In return, what would happen in future? That I will return your money back and you will give this piece of paper to me. Now, one more thing that could happen. You don't like my promise, right? You can sell this piece of paper to someone else, and that person can return this piece of paper to me. When the third person can redeem his money showing this paper, that person could sell this piece of paper to someone else. So this is how the transactions can keep going. The last person who will be holding this piece of paper, the last person, he can give this piece of paper to me and take 1,200 rupee back. So he will be making 200 rupee profit. And in between, what would be happening? The first person could sell it to another at 1,050, then 1,070, 1,080. This is how it will keep changing the hands. And the last person will buy it at 1,100. Now, once he will give it to me, I will pay him 1,200, as it was mentioned in the bond that I will pay 1,200 after 1 year. So he will make 100 rupee profit. So this is how bonds market work. So two people, one giving money, another taking money. So stock market. You all are aware of this stock market. What happens over here? Again, I need money. I took money from you, right? And I used that money in my business expansion. But in stock market, in equity market, basically, what happens? I don't return your money back. That money is mine, right? But over here itself, I will give you a piece of paper. It's not a promissory note this time. I'm not promising anything this time. What I am doing, I am giving you ownership that Mr. Ram had given 1,000 rupee to me and he is 1% partner in my company. You are a partner now. So it's a good thing. You are a partner with me. Now, if you buy 50% of shares, you will become 50% partner. Now, over here, I don't need to give your money back. Same happens in Shark Tank India. If you have seen that program, what exactly happens? They are buying partnerships in a company. Now, what would happen to this piece of paper then when I give you the partnership? You can sell this partnership to someone else. That Mr. Ashok can sell it to Ram, Ram can sell it to Ashneer Grover, Ashneer. So it can again change the hands. So it's again a market because I gave you my partnership and I took money from you, right? And that money I not need to return. And in the exchange of the money you gave to me, I gave you a piece of paper with mention where I mentioned that this person had purchased this much partnership in my company. That is your you can sell this partnership to anybody. But over here, the product is non-tangible. You can see, you can witness one thing that I am just using a piece of paper, guys, nothing else. So there is no tangible product. There is no good over here. It is everything is happening in a piece of paper. So one question that should come in your mind over here is that, sir, what would happen if World War takes place? Who will buy this piece of paper? Yes, it is an issue because it was a non-tangible thing. Sometimes this piece of paper will worth nothing, and sometimes this piece of paper will worth a lot. Let's the best example that could be instead of this piece of paper, if you would have purchased gold with the same amount, that gold would have been you could have used that gold anywhere else to buy something because barter system will still work. You can exchange gold against any product. But in the case of emergency, it will be difficult to exchange this non-tangible paper with exchange of anything. Because if there is no demand of these papers, means these promissory notes or equity, uh, you it will become very difficult for people to buy something in exchange. Yeah, it's a drawback. So that is why whenever a war takes place, whenever some bad thing takes place in the worldwide macroeconomic level activities, gold prices always goes up because gold is something which is considered as a good tool for barter. It's a very good tool if you want to barter something. I hope this is clear to everybody. Guys, bond market and debt market are synonym words. Basically, debt markets are called as bond markets. And within this, there is one more market that is money market. Now, this is again a very important concept, guys. You need to understand what happens in money market. As the word itself suggests, money. Money is cash. And the most liquid asset in finance is cash, right? So this is very, very liquid. This market is very liquid, guys. The first thing. In bond market, I can issue. In debt market, I can take money from you for more than 1 years. Means I can give you this promissory note and I can take money from you for more than 1 years. But in money market, there are no happy birthdays. So I use this word intentionally. There are no birthdays over here. Means I will be taking money from you for just few weeks or few months, but not more than 1 year. So money market instruments are again bonds, but these instruments are basically used by government of the country, government of India, government of America, the Federal Bank, Reserve Bank of India. These are the markets which are used by governments. Why they will be using? Because governments also needs money, right? So government will issue bonds. That please give us some money for 1 week, for 2 weeks, for 3 months, for 6 months. Why government would need money? To build, to construct roads, highways, hospitals, infrastructure in a country. This is one way. This money market instruments are also used to control inflation, guys, right? So being RBI, Reserve Bank of India, I will take the money from you and I will give this piece of paper to you. So when I took money from you, you don't have the money to invest, so inflation will go down. So RBI also uses this thing. Banks also use money market instruments to take loans. If a PNB needs money, what PNB will do? PNB will take loan from SBI, and SBI in exchange, PNB will in exchange will give some bonds to them. So money market instruments are used in interbank and intrabank as well. How PNB can take loan from RBI itself. So again, exchange of these bonds. So these money market bonds are specialized, I'm using the word, are specially used by governments, reserve banks, and the banks. And we people, we can invest in these bonds itself. Yes, we can invest, like treasury bills, sovereign bonds. So we can invest. Even one more thing, one astonishing thing I would like to tell you. One country also invest in another countries. For example, India also invests in USA, USA's governments, right? How? USA are Federal Bank of USA, they issues money market instruments, and Indian government we buy it and we keep it because Everyone is doing investments, guys. Not only we as a student, not only us as a student, everybody is doing investments. Like governments, banks, everybody, if they are having some surplus money, they invest somewhere. So money market instruments are used by governments as well to invest in inter-country. Our bank RBI invest in Federal Bank of USA, their bonds. Sri Lankan bank, they invest in RBI. So this is how one country is dependent upon another country. So if one country defaults, it is a chain system, entire world collapses. I hope this is clear to everybody. So money market instruments are the instruments which are highly liquid, highly liquid. Sometimes I can borrow money from you for very one day, for overnight. This is how banks take money from each other. PNB can borrow money from SBI for just one overnight, for one day. So this is how I can withdraw money for just very short period of time. I hope this is clear to everyone. So money market instruments are also debt market instruments. These are also bonds, but these bonds are, guys, for very short duration. One more thing, Reliance can take money from PNB. PNB can also take money from Reliance, again with the exchange of these money market instruments. So basically, money market instruments are government securities, sovereign bonds, treasury bills, commercial papers, CDs. You might have heard certificate of deposits. So certificates of deposits are issued by banks. Commercial papers are issued by private companies. So everyone use these instruments, guys. I hope this is clear to everyone. So bond market, debt market, and money market are similar thing, but just remember money is cash, and cash is the most liquid asset. So these are also bonds, but very liquid bonds. I hope this is clear to everybody. Now, derivative markets. Now, before we proceed this, let's cover this one, foreign exchange. One more example I would like to give you over here, guys. You might have heard that price of dollars are going up. Dollar is getting more and more strong. It's getting stronger and stronger every day. Is it can we as citizen of India invest in dollars? If Is it a good investment if I ask you a question? So if I tell you, it's not only us who invests in foreign currencies, even RBI invests in foreign currencies. Whenever, see, let me give an example. For example, here you are having 1000 rupee extra surplus. You can invest in FDs, RDs, PPF, or mutual funds, right? Equity, or you can buy currency out of that. You can buy some dollars, some euro, pounds, and keep that currency with yourself. It could be a hobby. It could be, some people have the hobby of collection. You can you can buy it for the sake of investment itself. So once the prices of dollars really goes up, then you can exchange it with rupee, because anyhow you can see the dollar prices are also going up. Always they're going up. Now one more thing, whenever RBI is having extra money, RBI also purchases foreign currency, forex, and keep it with themselves as a security. If tomorrow something wrong happens, at least they can use that dollar. If tomorrow something wrong happens in your family, and for God's sake, it doesn't happen, but if it happens and the power of rupee is very low, you can use dollar to buy things. So foreign exchange is again a market where transaction takes place for currencies. One person is buying a currency, another person is selling a currency. So this is again very important and very interesting as well. It could be a hobby. So the best hobby when you are young, guys, should be investing in mutual funds, investing in foreign exchange, or buying gold. If you have not, if you don't have the knowledge of equity yet, once you will have knowledge of equity, then that's also a good thing. Now currency pairs. How it works, guys, basically. In India, trading in forex is not allowed. It's banned by government because it's too risky and it's too volatile, basically. And it takes place 24 hours. Again, it's a very unique thing. There are many apps which will tell you that you can invest in forex. Please avoid doing that. Those all are frauds. Now, it means the similar pattern you are doing intraday or buying shares or stocks in a broker in equity market or capital market. The same way you can buy currency and currency pairs, USD, Euro, USD, Japanese yen. This is how you can buy the currency pairs. And there will be very small margins, very small fluctuations, means zero point 0.1 paisa, zero point 0.2 paisa, like that. But if the volumes are high, you can make profits from here. And many people do this trading as well. It's a good trading. Good returns are also there. but the volumes required is very, very high. You need to have good amount of volume and good amount of cash for this. So this is again one type of market. And foreign exchange is a very important topic for CFA and MBA. How the foreign exchange, foreign currencies are regulated. What is PPP? How the currency exchange prices are regulated. Who regulates that? We are going to discuss that thing as well. Very, very important. Right now, coming to commodity markets. Again, guys, these are goods basically, as I told you. Now there are two ways investing in commodity markets. Way number one, the let's see the types of commodity market: energy market, metal market, agriculture market. So there could be multiple markets. So agriculture market, within this it could be wheat, rice, soybean, coffee. In metals, gold, silver, copper, right? In energy, crude oil plays a very important role, natural gas, gasoline. So where the how you can invest, right? There could be arbitraging of the commodities itself. Means you can buy at cheap price at a place and you can sell it at a different place. The best example could be buy apples from Kashmir and sell it in Tamil Nadu. Best, you can make profits in between. Easy way, easy business. Buy coconut from South India, sell it in the North India. Best business. This is called arbitraging. Buying at lower price at a place and selling at a different place at a higher price. Way number one. But over here, you are buying the stuff in real quantity. You are buying the stuff in reality. Means you are buying something in reality. But guys, where would you store that coconut? Where would you store those apples? Because buying apple is one thing. Picking those apples, transporting those apples to South India, it requires transportation, logistics, storage as well. And even you need cold storage for this. Otherwise, they'll get spoiled, right? Now, what would happen? Once you'll buy, if you buy crude oil, where will you keep that crude oil? You need to have containers. Now, for this, what exactly happens, guys? There is a new technique of doing this. New, not exactly new, but there is another technique of doing this. You buy these on contracts. You don't buy the real stuff. You buy the products, but you buy the products virtually in paper. That today, I, Pranay Vyas, buy how much? 100 gallons of crude oil. So this is a piece of paper. A company would give it to me. That I am a owner of 100 gallons of crude oil. So I purchase, for example, I purchase this gallon of crude oil at 100 rupee. 100 gallons at 100 rupees. So cheap, but in reality, it won't happen. But for an example, 100 gallons at 100 rupee, I purchased it. Now, company gave me this piece of paper, mentioning everything that I am the owner of this. If I sell, if the crude prices goes up from 100 to 200, 1 rupee to 2 rupee, I can sell it, this piece of paper, to someone else, and I can make my arbitrage in between, and that person can redeem the crude oil. So that person can really buy the crude oil or give this piece of paper to the company. So this is called as contract trading or contract investments. So this is something we are going to do in derivatives. So in commodity market, guys, as I told you, you can buy these products in reality and you can store it somewhere, or you can buy the contracts of these products. In contracts, what is the easy way? That you don't have to store it anywhere. You just have to keep the contract with yourself. Once the prices goes up, you can exchange it with the money. As simple as that. Or once the contract expire, again you will get a redemption. That easy it is. So commodity markets, again, a very good way of investments. If you are good in understanding agriculture, if you are good at understanding the environment phenomena, commodity market is for you. Again, the profit margins are very low. Volumes should be very, very high. Because what do you think? Cost of wheat could increase in just 1 year from 10 rupee to 15 or maybe 12. It's just 2 rupee margin. So margins are so low, so that is why you need to buy huge volumes to have substantial amount of gains. I hope this is clear to everybody. Now, derivative itself is a big topic, guys. It's a big topic. So what exactly it is? These are contracts. Now it is becoming a bit tricky, and you should be knowing this thing. I will give you a story for this so that it becomes very easy for you to understand. You are a farmer, and I am Nestle India. I am a big company, giant company, right? Now, Nestle India, I produce Lay's chips. For that, I need potatoes. You are a farmer, you produce potatoes, right? Now, what exactly happens? Sometimes, being a Nestle, being a big company, I can buy potatoes at 10 rupee. Sometimes the prices are so inflated, I get potatoes at 20 rupee per kg, right? Now, being a farmer, again, there is an issue for you. Sometimes the cost of potato for you, the selling cost for the potato for you is 7 rupee, sometimes 10, sometimes 12, sometimes 2 rupee also. Because if the supply of potatoes, everyone starts, growing potatoes, the supply of potato will be so high that you will get 2 rupee. Or sometimes, they just have to give it for free. I mean, there is a huge huge discontent in the agriculture sector that we are going to discuss in a different class, that why farmers commit suicide, why there is so much mismatch in demand and supply over there. Now, what will happen? The farmer will come to the Nestle company and will get into a contract that I, Nestle, whatsoever happens in future, next year I will buy your potato at 9 rupee. And farmer, whatsoever happens, he will sell the product, the potato, to me at 9 rupee. So if tomorrow the prices of potato goes 2 rupee, the farmer will get 9 rupee from me. It's a promise. And if the prices goes 20 rupee for Lay's company, I will get the potatoes at 9 rupee. So it is win-win situation for both of us. Again, it's a contract, it's a promissory note. So I, Nestle, will promise you to buy at 9 rupee, and farmer will also sign that I, farmer, will also sell at 9 rupee. It's a signature. So after 1 year, if the prices are low, farmer wins. If the prices are high, I win. But both have win-win situation. This is called as forward contract. I hope this is clear to everybody. This is forward contract, and this is the most, you can say, basic form of contract any person can get in. But over here, one drawback was there, that being Nestle, being one of the biggest company of the world, I may not follow the contract. I can run away or I can bully the farmer, because farmer is not the powerful person over here. It's Nestle who is the most powerful. So he can't do anything against me. So to overcome this, future contracts came. Now, what is a future contract? Now, this time, if I tend to run away or farmer tends to run away, that's I don't have the potatoes to sell you, we will keep a security amount. That I, Nestle, I will put 10,000 rupee as a security deposit. And farmer also will keep 10,000 rupee as a security deposit. This is just a security token. I will not, that will be refunded after a specified period of time once the transaction is complete. And this security deposit will be given to a regulatory body or a third body or third person. So now three people are involved, three stakeholders: Nestle, farmer, and a class monitor or a government organization or a third friend of them, who will manage that no party disrespects the bond, disrespects the contract. Now, once the contract is done, I purchase the potatoes from the farmer, that 10,000 would be given back to me and to him as well. It is just a security amount so that we respect the contract. This is called as future contracts. So in future contracts, what we do, we keep a security amount and there is a third party involved. That third party could be government, and that third party could be any party, anyone whom these both the people are having trust. I hope this is clear. In future contract, there is also one more thing, that it is future oriented. So it is something going to happen in future. So you have to block your money for that specific period of time. Means you can't run away that next year I will be buying potato for, but for 1 year I will be blocking my 10,000 rupees. So this is how a future contract takes place. In option contract, as the word itself suggests you, option, right? So some kind of option is given. It's a bit flexible, guys. It's an interesting thing if I tell you. Now over here, farmer and Nestle again, they came together. Third parties again, they're sitting over there. That could be government for example. I asked farmer that we'll get into a contract that we will sell at 9 rupee. I will buy at 9 rupee, he will sell at 9 rupee. But as a name is given option, over here one option will be given to both of them that they can breach the contract in future. They may or may not buy. The farmer may or may not sell. Me may, being Nestle, may not or may. I can buy. I cannot buy. In future, I will decide. So I am giving a flexibility over here. So it's a contract that we are getting into contract at 9 rupee. So if this contract is executed, it will be executed at 9 rupee only. For just keep this thing in mind. But if farmer is getting a better deal, he can breach the contract. If I am getting a better deal, I can breach the contract. But over here, if any of the party will breach the contract, any of the party will breach the contract, the opposite party will get some compensation for that. That's the simple rule. Some compensation is not high, very minimal nominal compensation. It could be 1000 rupee, 2000 rupee. So here we are having an option to either continue with the contract or breach it. But if someone breaches it, so that person or that party has to pay opposite side some marginal amount of money. It is called a margin money, which we have to keep. Or over here, one more thing is that you can execute the contract as it was decided, and then the margin money will be refunded back. So over here, that is why options are given. So in equity, it is call and put options. You can buy calls, buy sell calls, buy put and sell put as well. Very interesting topic, guys. You can make money in equity upwards and downwards in using options. There are so many strategies using hedging over here, right? So very interesting topic, very long topic, but I hope you got the point. What is a forward contract? What is a future contract? What is option contract? Swaps, very interesting, very interesting. As a name itself suggesting you swapping of something. We are swapping something. Now, you are my student, I am a teacher. I am having 20 lakh rupee of investments in Reliance. You are having 20 lakh rupee investments in an FD. FD. I hope you're getting the point. Fixed deposit. Next 3 months, I think that Reliance can go down. Next 3 months, you can think that sir's portfolio is, sir had invested his money in Reliance, must be good. You believe that Reliance will go up. I believe Reliance will go down. What we will do, we will exchange it. I will take your FD and I will give you my Reliance. I'm not giving you my shares of Reliance and you're not giving your FD to me. We are just exchanging the profits. We are just having a bet over here. Interesting bet. So what I want to say over here, I am giving you my Reliance shares. So whatever profits they will make, those profits will be yours. And if they make any losses, the losses will be yours. You are giving me your FD. So whatever returns you will be getting from FD, those returns would be mine. And after 1 month or after 2 months or 3 months, we will end this swap contract. I will get my Reliance shares back and you will get your FD back. Means we were not transferring the ownership. We were just transferring or sharing we were just swapping the profits. If I would have made losses in Reliance shares, those losses were yours because I gave my profits and losses to you. It was your choice. You gave your FD's returns to me. So this is how swaps work. Very interesting tool, guys. Just imagine you can exchange it with anything. So you can exchange equity with banking things. You can exchange equity with bonds. So swaps can work anywhere now. So banking sector use swaps a lot. A lot means banks exchange government securities with equity. Banks exchange their returns with each other for 1 month, 2 months, 3 months. Huge teams are working on this. So this is how, guys, the entire markets are organized. Today we discussed financial markets. Today we discussed how the companies work. This is a very important topic and very interesting topic to understand, guys. This was a basic under this entire thing was for the basic understanding of what are markets basically. And in these all the markets and all the market types, there will be two people, buyer and seller. Always, always.